Hey, Dan Passarelli here. How you doing today? Hey, I want to make sure you can hear me. If you can, please head over to the Q&A box, panel, section, module, and give me a big woohoo. Hit that questions box for me, will you? Let me know you can hear me. Yeah, Justin is back in black. Nice. Tomas. Yes, 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 yes. Mike is here. Shane came back. Excellent. Welcome, Shane. Okay, folks. Today we're going to talk about something that I've been getting a lot of questions about lately. That's straddles and strangles. Straddles and strangles are pure volatility strategies, which makes you think, hey, you know what? In a market like this, where we're getting a lot of big moves, straddles or strangles should be awesome, right? Well, they can be, but there are some factors that need to be taken into account first. And today we're going to talk about those so that you can analyze your straddles and strangles like a pro. Now, before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is I'm giving generalized information, not specific to your personal situation. Now, I see some familiar faces. I don't actually see your face, but I do see your names, and those correlate very directly. So, you guys know who I am. You guys know what I do. But those new names, faces that I see, you might not know. Who is this crazy guy here? The man in black today, Dan Passarelli. Who is this guy? Well, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular options trading books. Trading Option Greeks is the one that I'm most known for, and we're going to talk about some things that are in that book, Trading Option Greeks, which is on Amazon. I also write lots and lots of articles. I have my Substack, Wealth Building with Options.substack.com. I write a whole bunch of stuff. I'm also a trader. I traded for years down on the floor of the exchanges in Chicago, the Chicago Board Options Exchange, Chicago Board of Trade, CME Group. And now I trade in a retail online trading account, just like you. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We have student traders in over 50 countries. We've put, I don't even know how many, tens of thousands of traders through our programs in one way or another. And I have been doing this so long, I've pretty much worked with everybody. All the major exchanges that trade options, I mean, literally in the world. Literally in the world, I've had some sort of interaction with every options exchange. It's really crazy to think about if you think about it. As well as the options friendly brokers like Firstrade here, who do a great job with their option platform offerings. And outside of trading, I do other things. I'm a family man. Those of you who are market taker mentoring student traders and have been moving your trading forward with our help, you know, my wife, Kathleen, she runs operations here at Market Taker. She keeps the ship afloat, if you will. And I have my two adult children as well. and we all as a family do lots of fun things. Um, I'm a runner. My wife's a runner. My daughter, I think she's signing up for her first half marathon, I hear through the grapevine, which is pretty cool. And we're all foodies. We love to cook. We love to eat. We love to travel. And we're a musical family. We love listening to it. Some of us play it. So that's who I am. But enough about me. Let's talk about the important person here. Let's talk about you. So I want to do everything that I can to move your trading forward so that you can be the best trader you can be. And holy moly, we're going to cover a whole bunch of that in today's webinar. After the webinar, if you haven't already, you should go to my website, markettaker.com. That's right up here, 2 T's in a row. Market like stock market, taker like take what is rightfully yours. Markettaker.com, 2 T's in a row. And just click on join free here. Doesn't cost you anything, but it gives you a whole lot. There's free classes there. There's discounts on certain trading stuff, a whole shebang. And let's talk about trading straddles. We'll start out with the straddle here, okay? So what is a straddle? Well, a straddle is when a trader buys a call and a put, both sharing the same strike and the same expiration. And it is a bullish on volatility trade. Now, I know some of the folks who are in the class today. I mean, to some degree. We don't have poker night once a week or anything, but we have something better than poker night once a week. Once a week, holy cow, the screen is really big over here. I'm on my other screen. I'm trying to pull up the Firstrade account here. I had my screen magnified. Anyway, yeah, we do something more important together once a week. We get better at option trading. So, all that being said, those of you who do end up coming over and over and over again, volatility means something specific to you. Volatility means to you one of two things: how much the underlying stock moves, and the implied volatility, which is the Vega movement. Straddles actually help with both. Now, let me take this down here a second here. Hold on a second. One second here. One second here. One second here. I forgot to make one little change on my slide. But you are too important for me to leave this sloppy. And I fixed it for you. So, okay. Imagine I buy a straddle. And you know what? Let's just take a quick little look-see here for a second, okay? We got the Firstrade account here. What stock should we look at? Somebody throw out a stock. One, ideally, that has liquid options. What's a stock that you think might move around a lot? Anybody? Bueller. Hey, Garish, how you doing, my friend? Mike. Oh boy, these are two good choices. Let's look at NVIDIA. I'm sorry to have subjected you to that. Actually, no, before we look at the options, let's look at the stock here first. Did I do that wrong again? Oh my gosh. You know what? That is what my brain is not functioning properly today. I say that every week. Maybe for me, a proper functioning brain is just one that doesn't work at all. Um, Now they're just pissing me off. There we go. All right, friends. Holy crap. Look at this stock. This sucker's all over the place. So this is let's move that way. Is Smidgerooski. This is about a well, let's look at a 1 year chart. What do you say? And let's change these to daily candles. You had to do it, didn't you? I guess we can just do it that way then, can't we? Over a 1 year period, this is what this puppy looked like. Went from 80 to 140 down to almost 90 to 130 to 150, back below 90, up to 135. This puppy's been all over the place in the last year. And, it kind of makes sense, right? Those of you who do fundamental type analyses, you typically look at stocks that have a track record in an industry that has a track record, products that have been out there, consistent earnings. And we've been getting consistent earnings from Nvidia, but this whole AI thing, there's a lot of speculation with it. What is it even going to be? I got a friend of mine who works at Microsoft and is very knowledgeable in AI. And I'm like, where's AI going? Like, what is the goal with AI? Like, everybody talks about it, like it's really important. Like, what's happening with it? And he's like, you know what? Nobody really knows. I mean, maybe like the big people who run like OpenAI and such have a vision that's playing out, but there's a lot of it that is just still playing out. And until it does, we're not going to know. So, like, our chip's going to be different. Like the what is it called? DeepSeek in China, where the chips use way less energy than the current NVIDIA ones. Is NVIDIA going to be a dinosaur in a year? Or is it going to do something even more revolutionary and it's going to be, they're going to sell a whole bunch of more chips? I don't know. Nobody knows. So that's why we have all this volatility. People who are believers in AI and have done some research and have reason to believe that AI can really continue to take off, they're going to be bullish. Some people who think it's overdone are going to be bearish. And that's exactly what we see, a battle between the bulls and the bears. That's what we see with all stocks. So because it seems to me that nobody or barely anybody really knows, we'll probably continue seeing some of this volatility. Could go up, could go down, but could only helps a little bit. We've got to set some parameters. How far do we think it could go up or down? In what time period? I mean, if we say, oh, $20, well, is that $20 over the next day or $20 over the next year? I mean, probably both of those are way too far away from what we're talking about. Maybe the next week or the next month. Now we're talking about something. Garish, what are your thoughts? NVIDIA, how far might it move over the next, how long of a period? Let's see if Garish throws in anything. In the interim, whoops. In the interim, going to go here to options. You think it'll move up or down by 7% tomorrow? Oh, that's right. Earnings. Oh, gosh. I forgot for a second there. Earnings is tomorrow, right? We go to NVIDIA, Investor Relations, and let's see. Today is May 27th. Tomorrow, May 28th, after the close, is NVIDIA's earnings. So, Garish, I would say that by the end of the day tomorrow, it probably doesn't move a lot at all because people are going to be waiting for earnings. But the end of the day, the next day, Thursday, then it could move a lot. So it's a little trickier when it comes to earnings announcements. I'm just going to tell you. We'll look at this really quick. But let's see, May 30th is this Friday. Options with less time to expiration move or have lower prices than options with more time to expiration, right? So their cheapest options are going to be in the May 30th, given the same strike price. So we could buy, or a trader could buy, the May 30th 135 calls at 495 and the May 30th 135 puts at 455. So we take out, I have a very sophisticated device with very sophisticated software that helps me make straddle decisions. Now, I'm just going to warn you right now. I mean, it's not something that I sell or market taker sells, but it is something you would have to buy. Third party, not related. I don't get any affiliate commission or anything like that. But you're going to have to buy one of these things, which you can only find basically anywhere. Walgreens, CVS, the grocery store, Amazon. You probably walk down the street and see one laying, in the gutter. And it might cost you up to $6 of US currency. They call it a calculator. And we're just going to add up the offers of these two options. So 4.95 plus 4.55 equals $9.50. So $9.50 divided by the stock price, because we want to see what percentage of the stock price that is, divided by 135.37. Garish, are you kidding me over here, man? 7%. So, if you are like Garish and you think that NVIDIA is going to move 7%, I'm assuming you mean after earnings. So not tomorrow, but Thursday. Am I correct in that assumption, my friend? Okay. All right. So if you did that, and I'm going to check something on my other screen here. If you did that, you would make zero. If you pay 7%, because 7% of the stock price is $9.50, Garish is expecting it to move $9.50. So if Garish bought the straddle and was correct, it moved exactly 7% or $9.50. Garish would just break even. It's a lot of risk for the expectation being to break even. So you'd probably not want a straddle. But that being said, the last gap from the close before earnings to the open after was 2.8% only. And the gap the quarter before that, November 20th, 2024, the gap was only 2.3%. And the quarter before that, the gap was only 3.6%. The last three quarters, we didn't move anywhere near 7%. Now, the quarter before that, exactly a year ago, well, May 22nd of 2024, the gap was 7.4%. So still, you would only have just about broken even. And the quarter before that, the gap was 11.2%. So you probably would have made money. But the quarter before that only moved 0.2%. Quarter before that, 6.6%. So buying this straddle going into earnings, you would have lost 1, 2, 3, 4, 5. Five of the over the last 2 years, you would have lost 5 times, broken even once, and made money once. Now, let me kind of expound upon what I'm talking about here. You're used to seeing these profit and loss diagrams, right? So the strike is $135. We're paying $9.50. So if you buy an option, you can only lose what you pay for it. So if I buy a call and a put and their values equal $9.50, that's the most I could possibly lose. Now, how does all that work? Well, if the stock is below the strike at expiration, the call would expire worthless and the put would be in the money. So the lower below the strike, the greater value the put has. If the stock is above the strike, the put expires and the call is in the money. And the higher above the strike, the greater the value the call has. So you're going to lose on the call if it goes down, and you're going to lose the time value of the put when it goes down, but you make the intrinsic value of the put. This is all at expiration. Likewise, as stock goes up, you lose all the complete value of the put and the time value of the call, and it's only intrinsic value for the call. So the only way you lose $9.50, the entire value, is if the stock is exactly at the strike and there's no intrinsic value in either of them, which is unlikely, but still, I mean, if it's a dime away, I mean, you're still going to lose everything except a dime, right? So we need NVIDIA to go through the break evens, which you've already, well, I guess we haven't established. So let's talk about that. What are the break evens? If the strike price is $135, how low does it have to go at expiration? But, you know, if we're saying this is a picture of the stock at expiration, how low would the stock have to be to break even, or how high would the stock have to be? There are two break evens. Who can tell me what those break even prices are? Who can tell me what those break even prices are? Now, remember, the strike is $135 a share. I know there's somebody here because we get 125 and 145. You're close. You're rounded, though, Mike. I want the exact answer. Call me a nitpicker, but I want the exact answer. We're assuming we're paying $9.50 for the straddle. Well, the call, let's start from the call side, would have to have an intrinsic value, because remember, all the time value disappears. It's only intrinsic value. There we go, Mike. I knew you had it. Wait, is that right? Oh, Mike, I know you have the right idea, but I think you're just going too fast here. But close enough. Close enough. So here's how that works. The intrinsic value is the only value you can have after expiration. And obviously, we'd want to close this before expiration, yada, 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 as George Costanza would say. But work with me. If intrinsic value is the only value any of these options would have, because all the time value is gone, we're going to assume we lose $9.50. We lose what we pay for it. So this has to have $9.50 worth of intrinsic value. So the strike price, 135, and the put's going to be, if we're above the strike, the put's going to expire. We don't care about the put. So this is the calls strike, 135 plus 950. I had to use my very sophisticated, costly device. $144.50 is the upper break even, which is just the strike price plus the call's intrinsic value. Well, plus what you paid for the straddle is what the call's intrinsic value would need to be. But if we're below the strike, the call expires, and the put's intrinsic value needs to be $9.50. So we'll go $135 minus 950 is $125.50. Now, based on prior gaps, this would be a terrible trade. But isn't that weird? We think about straddles as this volatility strategy. If we think a big move is going to come, and hey, let's face it, 2.8%, 3.6%, those are not small moves for a day, but we'd still lose money on the straddle if we bought it. The straddle is actually overpriced in this case. Well, what about this thing we call a strangle? Well, a strangle is when a trader buys a call and a put, but the put has a lower strike than the call, but same expiration. Usually both of them are out of the money. So higher strike call than where the stock is, lower strike put than where the stock is. Oh my gosh, sorry about that. There's also a bullish volatility trade, but it's just a little bit different. What the heck just happened here? Here, we would do something like buy the say $4 away, 131 puts and 139 puts. Each of those are $4 away from 135. So we'd pay 282 and we pay 315. That comes, I mean, I can do this in my head, I think, right? $5.97. But it would have to be $5.97 below the put strike or above the call strike. How does that actually look? Well, it looks something like this. If we're below the put strike, it's got to be $5.97 below 131. So let's just round it to $6, okay? So it's got to be at 125, which is actually farther. It's got to move actually more to break even. If it's above the call strike, it's got to be, again, let's just round it to $6. 145, which is actually a little 50 cents wider than the straddle. Boy, this seems a lot worse of a trade, doesn't it? Well, here's the difference. We risk less. Most we can lose is what we pay for it, which we're just calling $6 instead of $9.50. So we risk a third less, but it's got to move a measly 50 cents more. Oh, so that actually sounds kind of good. But there's still another thing. If we're between the two strike prices, remember, both are out of the money. Both options can expire worthless, and we run the risk of a maximum loss. Whereas with the straddle, the only way we can get a maximum loss is if the stock is exactly at the strike price, which it seldom is exactly at the strike price. But here, if we're between 131 and 139, which is a pretty big range, we can hit our maximum loss. So they're similar, but they're different. Let's look at a more conventional straddle example. And let's look at Apple. Because Apple has already had earnings. Right? Let's verify that. We always go to their investor relations page. On March 29th, oh no, no. On May 1st, they had earnings. On May 1st, they announced today the results. So Apple's earnings for this quarter are already out. So this would be a more normal straddle. The earnings ones are tricky. Apple, though, has its own volatility drivers these days. And that is the whole tariff thing. Trump called out Apple's CEO Tim Cook by name and by company last week, saying Apple doesn't produce products in the United States, they're going to pay tariffs. It's not just don't produce them in China and produce them in India instead. It's produce them in the United States or you're going to pay tariffs. He literally called Tim Cook out by name. So Apple gets the brunt of a lot of that. And it fell pretty good. Fell from almost 215 down today to 130. Well, what's the low of the day here? 193.46. Pretty big move. But Hey, man, if you've been paying attention to this, Trump says we're going to add more tariffs to the EU. And then the market goes boom, 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 boom. And then a couple days later, he says, we're going to extend the deadline. Boom, 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 boom. And it goes back up. So you can have a lot of volatility, which is what we're seeing. And even though he called out Tim Cook by name and Apple by name, he could say something tomorrow that could cause Apple to zip up to 220. It's probably unlikely, but it is possible. If you're paying attention, it's possible. So we could have some volatility in Apple. What are the extent of the tariffs? We don't know that either. The only country we have a deal with is the UK, and not even all the aspects of that deal are completed yet. Tim Cook said he was going to make Apple products in India. What's the tariffs going to be in India? Could be 25%, could be 1%. If it's 1%, that's barely going to affect the price at all. We could see Apple back up to, let's see, April 3rd was when these tariffs went into effect. And we could see it back up to 220 if Tim Cook said, yeah, we're going to do it in India. And Trump says, well, we made a deal with India and it's only 1% tariffs. This is it would probably overcompensate and be well above 221. Or Tim Cook could say, well, we're just not going to do it in the United States. We're only going to do it in India. And Trump could have a deal with India that says 25% tariffs. Now, 1%, 25%, in my analysis, both of those are probably too far out of range. But I'm giving some extreme but possible examples. If that scenario happened, we're going to make it in India and tariffs are 25% in India, we would probably see Apple sell off a whole lot more. So yeah, this is probably a pretty good one for a straddle here. Who gave me that one? Who gave me that one? Mike. Thanks, Mike. So let's see here. The question becomes, in what time period do we think Apple can move by what amount? So Trump extended the deadline until July, 9th for the EU, I think, right? I don't know how many components Apple buys from the EU, and I don't think they have any factories in the EU, so I don't know if that one really even matters. I think it's India or China. I don't even remember what those deadlines are. So, gosh, I don't know, Mike. Do you have any parameters? Because you have to start out with parameters. Otherwise, you don't know what expiration to pick. And, as far as your time horizon. And you don't know if the break evens are there or not. So, I don't know, Mike, if you have some parameters you want to throw in there, throw them in there. In the meantime, let's look at what is, oh gosh, I hate when I do that. Let's look at what is possible here. Okay. Trading options, Apple, get option chain. Wild guess, 6 weeks, $25. 6 weeks, I think, is enough time. Yeah, that's not a bad guess at all, right? So 6 weeks from now, well, May 30th is 3 days. So let's just basically add 6 weeks to that. We're talking about the middle of June here, right? We usually like to buy a little bit more time than the exact date. Why do we like to buy more time on straddles or strangles? Who can tell me that? This is an answer that I'm going to be impressed if you know. There you go, Justin. I figured somebody who's been our question answering leader would come up with the right answer. Theta. It's all about the theta. So look, the June 13th is about 6 weeks. Well, let's look at the July 3rd also. And let's look at the Greeks. So the at the money is going to be the 200 strike because we're at 253. The theta, which is, what's theta? Who remembers what theta is? Theta is how much the options lose per day. So if I buy this Apple straddle, if I buy the 200 call, I'm going to lose 17 cents a day. And the 200 put, I'm going to lose, let's just round that's 15 cents a day. So I'm going to lose 32 cents a day. Okay. It was 32 cents a day if I buy the ones that expire right exactly when I think the move might occur by. Hypothetical example. But if I buy 2 more weeks' time, I actually only lose about 12 cents a day on the call and 9 cents a day on the put. Only lose about 21 cents a day. Wow, I lose like a third less per day. Holy moly. And as we know, as time passes, theta gets bigger. Like let's look at the May 30th theta. On the May 30th theta, I lose 54 cents a day on the calls and 35 cents a day on the puts, lose, oh my gosh, almost 60, or wait a minute, almost 90 cents a day, rounding up a little bit. So the thetas of both of those get bigger. I mean, we really would prefer to buy the longer term ones. Now, all that being said, the prices get a little higher then, right? For the longer term ones. I can buy the June 30th or June 13th ones for, let's see, $6.10 plus $5.10. It's $11.20. But if I buy an extra about two, actually, it's an extra 3 weeks. Instead of $11.20, I'm going to pay $8.55 plus, well, let's just say $8.50 plus 7. We'll make the math easier. $15.50. So we pay a little bit more, but we will lose less. So that means if we go back to our straddles, and we're thinking about this as a retail trader, which we are. When I say that strike was 200, right? So the shorter term one, oh geez, you know what? I forgot the numbers. I should write them down. I'm gonna write them down. So the June 13 200 straddle is 590. Yeah, so 11.20. The July 3rd 200 straddle is So 830, 720 is 1550. Okay. Yeah. Oh, see, WK is a step. Oh, shoot, WK. This year is just flying by so much. I was thinking, oh gosh, you're right, man. June 13th is only 2 weeks away. How is June 13th 2 weeks away? Can somebody explain that math to me? I mean, I understand the math, but I mean, can somebody explain the physics of time to me? How is how is it the end of May right now? It just seems impossible. So you're right, WK. Oh my gosh. It just seems like June is so far off because, New Year's Day was like yesterday, right? So let's reconfigure here. So July 18th would be 3 weeks away. We could buy that and the same, it's going to be the same thing with the Greeks, right? July 18th compared to August 15th. July 18th theta for the 200 strike. We lose 10 cents a day on the calls and 7 cents a day on the put. That's 17 cents. $0.17 theta. And the AUG 15 theta is what? 8.5 plus 6, 14.5. So still a difference. Now, as far as the prices go, you could pay 980 and 840, 17, 1820. And for the August, we paid 1275 and 1085. So that's 22. What is it? 2360. I can consult my very sophisticated, expensive machine, but I think I did it right in my head. So let's take a look at our straddle here. Our break evens would be 200 plus 1 8 or plus 1820, so 21820, and 200 minus 1820, so 28180. And we're just going to add $5.40 if we buy more time to get lower theta. We're usually better off buying more time to get lower theta because what happens here is this is the break even. We're not going to hold it all the way until expiration. As soon as we can get a good profit, we're going to close it. So we really end up, if we're not holding it till expiration with this P&L diagram, we're usually going to end up with something more that looks more like this. Whoops. So we'll lose less, but we can still make pretty decent money. Oops. Let's get rid of that annotation. Do I get rid of that? Mouse. Well, it's just annoying. Well, anyway. Um, okay, so what do we cover so far? We covered the break evens, and we covered wanting to buy a little bit more time with the straddle. Let's look, though, at a bit of a more historical perspective. And if we go back to the chart, oops. If over the next 6 weeks, it's got to move either $18 or $23. I mean, first of all, is one of those really significantly better than the other or not? Let's see. So $18, I think I can draw a line here, would be about here. Oops. Or stop it, stop it. Or here. Oops. And then $23 would just really be a little wider. Gosh darn it. Goofed up there. Barely really any difference. And one more. I don't think you actually really needed me to draw these lines, but this is close enough. These two seem like they're not as far apart as they should be, or these are far, I don't know, close enough. I mean, really, it kind of doesn't matter too much. I mean, for a 6 week period, because when was 6 weeks before now? Right around here when like the massive uncertainty ended. And now we just got regular uncertainty. When you draw the lines on the chart, it kind of feels like we would have to really get a very decisive answer by then to break out of this range. So in this case, the straddle becomes a bet on when tariffs wrap up. Do we really think the tariff thing will wrap up by 6 weeks from now? The answer might be yes, or it might be no. I don't know. I mean, nobody knows, but it's not inconceivable that they get wrapped up within 6 weeks on at least some countries. But it's not a sure thing by any stretch. So this is kind of an interesting trade. Now we're almost out of time, but there's one more thing I want to share. What determines how far apart these break evens are? Well, the price of the straddle, right? But what kind of things can change the price of the straddle? Well, stock price, but I mean that just takes the lines and moves them together, you know, they stay just as far apart, but they move. Time passing, but that's the difference between the two lines. That's just what expiration we pick. Adding 2 weeks to the 6 week example, getting 8 weeks may well encompass the next. Oh, that's true. That's true. The August Well, when was the last Apple's earnings report? I know we just looked at it. It was like the beginning of April, right? Oh, let's just double check it. Oh, it was May 1st. So probably around July 1st would be the next earnings announcement. So I think both of these would encompass, wait, no. August 1st would probably be the next. Yeah, so very good observation, WK. I like I like when we have more people here to compete with the likes of the other smart folks in the room here. So, gee, I mean, to me, like all before I get into what I was about to get into, all else held constant, the August is probably a significantly better buy because we could end up holding it through the next earnings. And you know what's very likely to change between now and then for the August options? Implied volatility. Implied volatility determines how wide or tight these are right now. And as earnings approaches, implied volatility will widen these because it'll make the it'll make the time decay base. I mean, the time decay will be the same, but it'll be counterbalanced by implied volatility rising. So it'll appear like the time decay doesn't affect it as much. So that's the Vega effect on straddles and strangles. It's going to be the same for either. And so Vega is a thing that we're going to want to look at. We can look at implied volatility charts, which you can, just Google it. You can find them online for free. But the more the implied volatility is, and you can just look at VIX too. As VIX goes up, it's safe to assume, it's not safe to assume, but it's not unreasonable to assume that the implied volatility of all options will go up. So we've got that thing that affects it as well. Man, interesting type stuff here. Okay, friends. So that is everything I have to share today about straddles. Hopefully I gave you some good tips that can prevent you from just saying, oh, straddles are volatility trades. I think the market's going to be volatile. I'll go out and I'll buy some straddles. After today's class, you're not going to do that anymore, are you? After today's class, you are now armed with a great deal more information so you can trade these better and make much better decisions. So, friends, I hope that helps. This is Dan Passarelli. Have a great rest of your day and trade smart. I will see you next week when we talk about mastering the knockout pattern. Bye, friends.